Hello and welcome. Welcome to this webinar on climate change disclosure presented by Finance and Sustainable Initiative. It's a program by Finance Montréal in collaboration with Ceres. My name is Rosalie Vendette and I am a sustainable finance expert and independent consultant, and I will act as your moderator today. Finance Montréal is Quebec's financial cluster. Its mission is to develop and promote Quebec's financial service industry. Finance Montréal has been active in promoting sustainability for many years now and wants to bring information on sustainable finance topic for all market participants. This webinar follows a morning meeting Finance Montréal held back in January when it was still possible to meet in person. That seems like a while ago. Back then, for those who attended, we had an overview of TCFD with a presentation by EY, followed by a panel with the Desjardins Group, representatives of Desjardins Group and Rio Tinto. So if those presenters are connected, hi to you. An examination of 950 companies in 34 markets revealed that 54% of the companies assessed disclose climate change related risks. Quality is rated at 27% according to EY. Coverage and quality of disclosure are improving, but still few companies disclose on risks and opportunities revealed through scenario analysis. And limited progress has been made in addressing climate change financial disclosure between 2018 and 2019. By the way, EY has released its last week, its 2019 EY Global Climate Risk Disclosure Barometer, and I encourage you to take a look at it. We will provide the link to the webpage at the end of this presentation. As we get started, I'd like to begin with a few housekeeping remarks. Of course, everybody's on mute, but feel free to ask questions throughout the webinar using the Q&A function that you can see at the bottom of your screen, and we will keep them for our Q&A at the end. You'll even have the possibility to vote for the question you like the most. This webinar is recorded and will be available for those who miss it. We will be sending all the details on that via email afterwards. Climate change, of course, no need to expand on the immense challenge it represents to our life. But when it comes to making decisions, investment decisions, lending decisions, there is, as Mark Carney calls it, a tragedy of the horizon that's in front of us. The catastrophic impact of climate change will be felt beyond the horizons of most actors. It will impose costs on future generations that the current ones has little direct incentive to fix. In other words, once climate change becomes a defining issue for financial stability, it may already be too late. Those are not my words, those are his. And to allow one of the essential functions of the financial markets, to price risk, to support informed, efficient capital allocation decision, the Financial Stability Board, under Mark Carney's leadership, formed in 2015 a task force. Its name is Task Force on Climate Change Related Financial Disclosure, or the acronym TCFD, which released its final recommendation in June 2017. So that's 3 years ago. This webinar comes at a special time. I'd like to acknowledge those who are suffering from the pandemic related to COVID-19. In recent announcement, May 11th, the Canadian government has made disclosure following the TCFD recommendations, a condition for large corporations to receive the aid under the Large Employer Emergency Financing Facility, or LEAF program, its acronym. This gesture from the federal government follows one of the 15 recommendations that were issued by the expert panel on sustainable finance last year, 1 year ago in June. Even if our lives are turned upside down these days, the challenges related to climate change remain, and the work done by companies and financiers is continuing. So this is why we've decided to explore this topic further. Today's program is in 4 parts. First, we will hear from our first speaker, Peter Ellsworth. He'll do a deep dive into the TCFD recommendations and tell us more about the implications for issuers and investors. That's for about 20 minutes. Second, we will turn over to an issuer, Tech Resources, represented by Chris Adachi, who will tell us more about how to prepare TCFD disclosure, but more importantly, the type of conversations and work it triggers internally, and how it helps a company inform its climate change strategy and influence its business model. That's for about 10 minutes. Third, we will shift gears and turn into a conversation mode, where Bertrand Mulot from Caisse de dépôt et placement du Québec will join us. And then fourth, we'll leave 10 minutes at the end to answer questions that you will have asked using the Q&A button below. And we should close at about 11 this morning. As mentioned, this webinar is conducted in partnership with Ceres. So before we move to our first presentations, I'd like to invite special guest Tessa Heb, who represents Ceres in Canada, to tell us more about this organization and introduce our first speaker. Tessa, over to you.
Thank you very much, Rosalie. It's a real pleasure for Ceres to co-host this webinar with Finance Montréal. So we're very pleased to be with you today. Let me tell you a little bit about Ceres. Ceres is a champion of sustainability, and it works with the most influential investors and companies in North America on a range of sustainability issues, with climate risk and climate change chief among these issues. Ceres is a not-for-profit, and it's based in the US, and it builds relationships to drive these solutions throughout the economy. We are working to expand Ceres' footprint in Canada, doing more in the Canadian environment, and I'm pleased to represent Ceres in this initiative. And we have many Ceres members in Canada, several of whom are joining us today. So I'd like to introduce our first speaker, Peter Ellsworth. He's going to provide an overview of the TCFD. And Peter is a senior director at Ceres for 8 years. He's been managing the key relationships with investors and asset owners and investment managers that's part of the Ceres Investor Network. So Peter, over to you. Thank you.
Good morning. Thank you, Tessa, and welcome everyone. I'll do a quick check with Rosalie that you can hear me.
Perfect.
Good. This part of the session was advertised as a deep dive into the disclosures recommended by the TCFD, which for good order is the Task Force on Climate-Related Financial Disclosure. If you'll let me take some liberties with that deep dive metaphor, I see from the list of registrants that some of you have the scuba gear to go swim with the sea turtles, and others are more at the snorkeling stage. I'm going to do the impossible and try to satisfy everyone. And I hope get each of you thinking about the TCFD in different ways, and maybe prompt some questions for you to ask the panelists that follow me. I'd like to start with a 5-year flashback to the original press release issued by the Financial Standards Board announcing the establishment of the TCFD. As these two quotes by Mark Carney and Michael Bloomberg convey, the TCFD is not a check-the-box exercise. Its purpose is to provide a framework for consistent and transparent disclosure of an organization's exposure to climate risk. We commonly use the shorthand TCFD, but that does some injustice to the underlying intent, which is to describe how climate change will impact the financial well-being of your organization. Let's fast forward to today and indulge me in a final deep dive reference. Next slide, please. Let's take a minute to put on our scuba gear and see what's actually in the water. This slide shows the 4 overall categories of disclosure recommended by the TCFD and the 11 subcategories. I'm not going to take time reading through this, but in a minute, I'll look briefly at governance and risk management, and then in more detail about two categories that prove more troublesome to many: strategy and metrics and targets. What kind of risks is the TCFD talking about? In the spirit of taking nothing for granted, let's do a quick review. The next slide, please. There are two broad categories. One is transition risk. What challenges is your organization going to face during the transition to a low carbon economy? Certainly, policy and legal risk is one. Policymakers and regulators are going to become more active, and stakeholders will become more litigious. Disruptive technology is another. What could be more disruptive than a fossil fuel-based economy transitioning to a cleaner energy one? And all the innovation and obsolescence that will accompany this. Market risk. How is your organization positioned for shifts in supply and demand, or for products, services, and commodities? And reputation risk. How are your customers or the community at large going to perceive your organization during this transition? Are you ahead of the curve? Behind the curve? Perception is a very powerful force that impacts competitiveness, the brand, and the organization's value. The second broad category is physical risk, which can be event-driven like a flood or a hurricane, or it can be chronic, like sea level rise, which reflects the longer-term shift in climate patterns. The financial consequences of climate change also include how your organization identifies and embraces the opportunities created by the transition to a clean energy economy. It may come from sourcing clean energy, from being more energy efficient, from developing low emissions products, from servicing the evolving low carbon economy, from collaborating with innovators and communities, and from making long-term assets more resilient to climate change. If this sounds to you like some of it's more directed towards companies than investors, there's a reason for that. The first set of recommendations issued by the TCFD were, in fact, focused on how companies should disclose climate-related financial risk. A second set of recommendations was later issued for banks, insurance companies, asset owners, and asset managers. The TCFD called it supplemental guidance. At the 10,000-foot level, the expectations from the TCFD vary depending on what type of financial institution you happen to be. Next slide, please. It breaks down like this for the main 4 categories of the TCFD and the 11 subcategories. In short, there are specific disclosures in some of the categories that the TCFD would like to see from investors when they turn the climate risk on themselves. At its most fundamental level, it concerns how investors are managing climate-related financial risk in their portfolios. And I'm going to say it again, when they turn that risk lens on themselves, what are they seeing? If you're a company, this is incredibly important. And it's where the TCFD intersects and informs the entire capital markets. Investors need to start aligning their portfolios to the goals of the Paris Agreement. And if you're a company with a high carbon intensity in an investor's portfolio, you may look like a much less attractive investment. Companies in particular need to understand that the TCFD is not about sorting good and the bad. It's about clearly telling a credible story to help investors understand how you're currently addressing climate as a business challenge and how you intend those plans to evolve in a way that makes you a sustainable company and a good investment. It matters less where you are today than what you're actually doing and how. If you're a company, investors want to understand how your business is preparing for a global warming scenario below 2 degrees Celsius, but also how it will cope if global temperatures increase to 3 degrees or even 4 degrees, which will prompt an even more drastic policy and regulatory response. Does your company tell a convincing enough story through the TCFD disclosure process to give investors confidence that you're a good long-term investment? And if you're an asset manager, do your asset owner clients want you to continue managing their money? And if you're an asset owner, are you fulfilling your fiduciary duty to your members and beneficiaries? Next slide, please. It's going back to the 4 main categories. This brings us to the first of the 4 TCFD categories, governance. A handful of well-intentioned staff is a great start and can be a catalyst for internal change, but organizational change requires leadership from the top, from the board and senior management. Ideally, it should include accountability. I ask you to look carefully at the TCFD's guidance on governance disclosure. If you can't clearly describe the board's oversight and management's role in assessing and managing climate-related risks, you need to make that a priority. Companies of all kinds and investors of all kinds need to identify the organization's climate-related risks, which we listed a few minutes ago, and be able to describe how they're managing them. This is the risk management category of the TCFD. Which of these transition and physical risks related to climate change are material to your organization's financial health and sustainability? You need to know that and be able to clearly articulate it. One early step is to establish a baseline for your organization's carbon emissions or carbon intensity. A common approach is to conduct a carbon footprint. It will prompt questions and give you a benchmark for measuring progress. In a perfect world, your carbon footprint will assess 3 categories of carbon emissions: emissions directly attributed to your operations, emissions from purchased electricity, and emissions that are attributed to your supply chain and your use of products. If you haven't done a carbon footprint yet, not only do it, but explain in your disclosure process what you learned and how it will inform your next phase of climate risk management. This section of the TCFD is also where you describe any engagement activity that addresses climate change. For investors, that's relatively easy because virtually all of them routinely engage with their portfolio companies on a variety of material issues, including climate. If you represent a company, explain how those dialogues with investors help shape your policies and practices related to climate change throughout your organization. I mentioned before the 2 most troublesome categories for everyone trying to responsibly comply with the TCFD recommendations. They are strategy and metrics and targets. These categories are closely linked, and they also intersect with carbon footprinting. But where carbon footprinting is a snapshot of emissions of a particular moment in time, this strategy section of the TCFD, which asks organizations to disclose the actual and potential impacts of climate change, is forward-looking. It asks the organization to assess the prospects under different plausible climate scenarios and different time horizons. One approach is scenario analysis. Let's quickly look at that first. Whether you're a company, a bank, an insurer, or an investor, this is hard to do. And for most organizations, requires help from an outside party for data and modeling expertise. The good news is there's no shortage of organizations prepared to help. Next slide, please. Here's a representative list, far from complete. The not so good news is that each one is going to give you different information that will depend on the data they use and how they model different climate risks over short, medium, and longer term time horizons. Whether you're a company or an investor, you need to do some homework. Here are some starter questions to ask yourself, and then ask any service provider you may be considering. What questions are you actually trying to answer? What aspects of climate risk concern you most? Will the output enable you to make better business or investment decisions? These are important questions. Next slide, please. Or you might end up with less than you expected. Next slide, please. Traditional scenario analysis tends to be quantitative, and its output often requires interpretation. Another approach to use as part of your TCFD disclosure is more discursive. How is the organization positioning itself over a range of plausible global warming outcomes? How is the organization, in addition to reducing carbon emissions, going to successfully embrace the opportunities that will accompany the transition to a clean energy, low carbon economy? And what markers or signposts is the organization paying attention to? These can all be incorporated into your TCFD disclosure. The strategy section of your TCFD report should be a catalyst for thinking about your organization's future. How is climate change going to impact your competitiveness and financial performance and your relevance to clients, and to beneficiaries? Even your survivability as a viable organization. The metrics and target section is where the organization should be describing the tools and resources it's using to identify and manage its climate risks and opportunities. The TCFD is really a way to help you formalize storytelling in these key areas of governance, risk management, strategy, and metrics and targets. It's also a springboard for dialogue between companies and investors. I would encourage companies to look at the report issued by the Investor Leadership Network, whose Canadian participants included AIMCO, CDPQ, CPBIB, OMERS, Ontario Teachers, and OP Trust. Their report, which advocates for stronger climate change disclosure, can help companies better understand what investors are looking for. Everybody on this call is part of a financial ecosystem that's facing the inescapable challenge of climate change. You're all going to have to modify your behaviors and how you think about the short, medium, and longer term, and what the financial consequences of climate change will be for your organization. There are many ways to dive into the TCFD. This has been one, not so deep or long that anyone needed a decompression chamber, yet perhaps it will prompt you to consider how you disclose your climate-related risks differently the next time. Next slide. I'll end with a page of resources that you should find helpful. These are a few of many, and with the invitation to watch for future sessions we're planning in Canada with other organizations once this virtual world is behind us. Thank you for listening. And the next and final slide, please. Back to you, Rosalie.
Thank you, Peter. Thank you for this deep dive. A lot of good explanation and tips. So let's turn now to tech resources. It's my pleasure to introduce our second speaker, Chris Adachi. Chris is Manager, Sustainability and Climate Change and joined Tech in 2009. Chris's work focuses on a spectrum of issues related to climate change, including policies, regulation, public reporting, disclosure, energy and carbon performance and management. Chris is also a member of the Mining Association of British Columbia's Climate Action Working Group and the Mining Associations of Canada's Energy Task Force and the International Council of Mining and Metals Climate Change Task Force. Chris, can you tell us what the journey it's been to implement TCFD recommendations at Tech, and how far are you in this journey?
Sure, and I'll cover that a bit in my slides as we go through this. I'm probably going to steal some of my notes from my slides here, but we released our second report about a year ago now. This is something we've been tracking ever since essentially Mark Carney's speech in 2015. And this is something I think that's basically a core practice for us now. We're still working through a number of the nuances, and I think Peter did an excellent job of providing that overview. I was thinking to myself as Peter was speaking, I feel a bit like the professor has just explained the course materials and now I'm writing the test to see how tech is performing against those criteria. But what I'll do is
we're not scoring.
Maybe you aren't. We'll see what people at home are doing. But with that, Tessa, Rosalie, maybe I'll jump into my slides because I think it'll tell a bit of that story. So for those of you who aren't familiar with Tech, just a quick overview. We are Canada's largest diversified resource company. Our operations and our projects are in the Americas. On the screen, you'll see the four primary commodities that we produce, being copper, zinc, steelmaking, coal, and energy. And I provide some of that context, not just so that you're familiar with Tech, but if you think about those commodities and where we're operating, they are incredibly integrated with our climate change strategy and some of the materials I'm going to provide for you today. Next slide, please. So today I'm going to talk a bit about climate change. This is part of what I'd say is our broader sustainability strategy. And of course, I'm not going to get to the broader strategy today, but I would like to encourage people, if they're interested in learning more about our sustainability strategy, we do have our annual sustainability investors call. It's tomorrow morning at 8 a.m. Pacific, 11 a.m. Eastern. If you're interested, you can go to our website and register and join. But moving back to our approach to climate change, on the screen is sort of what we describe as a four-pillar approach to climate. And I think it's a nice way of packaging up how we think about where we need to go in terms of risks and opportunities. The first pillar for us is positioning ourselves for a low carbon economy. And this is really thinking about how decarbonization and how adjusting to a changing climate are going to influence long-term trends around demand and supply for commodities. I think the demand side is one that's probably obvious to people, what's going to happen to copper demand in the future as the world decarbonizes. But the other piece of positioning ourselves is the supply side. And Peter, I really appreciated your comments about understanding your carbon intensity. This is something that's really important to us. We have quite the advantage given where we're located with access to renewable energy. And so our assets have a low carbon intensity. And that means that in the long term, as we see investors shifting towards lower carbon providers, and as we see things like carbon taxes increase around the world, this will shield us from long-term exposure. So that's an important part of positioning ourselves for that low carbon economy. The second pillar for us is about reducing our carbon footprint. And so we know that while we are starting from a good position, that we have to take more action if we're going to help the world limit increasing temperatures. But we also know that our competitors are going to look to reduce their carbon footprints as well. So this is about maintaining our competitiveness long-term. The third pillar there is really supporting the use of carbon pricing policies. We think that governments have a role in providing the incentives and setting the direction for industry and the economy as a whole to make sure that we're all transitioning smoothly. And the last pillar for us, and I'll talk about this a bit more in the following slide, is ensuring that we're adapting to the physical impacts. And, you know, my experience here is I think a lot of our conversations to date on climate tend to focus on the first three, or that mitigation side, but the adaptation and the resilience piece is one that I think people are starting to appreciate more how important that's going to be to ensure that you can maintain your operations as the world changes. Now, the four-pillar approach I've shared with you is something we actually established back in 2015. It's something that we continue to use. And when the TCFD recommendations came out, they married up quite well with that approach. What I'd say is they actually, they help us, the TCFD adds another layer to how we can look at those pillars. And on the right-hand side of the screen, you'll see the second TCFD related report that we produced in 2019. And the following couple slides are a couple of the pictures that I thought I'd share with you from it and speak a bit more to our experience in producing the report. Next slide. So as a starting point, especially in the last version of our report, one of the things that was important to me was to take a concept like the TCFD that can often be, or scenario analysis as well, that can feel abstract to people. And when you get into the meat of looking at scenarios, can feel daunting. You know, what are the range of scenarios that we're talking about in the future? And I thought it was important for us, both internally and externally, to try to visualize and understand, well, what could a low carbon economy look like? And so the graphic on the screen took a number of the sort of scenario analysis pieces that we report out in our report and tried to actually just visualize, you know, what could a city, a rural landscape, a mining landscape look like in 2040? And so not only does it help people realize potentially, you know, this isn't necessarily something like Back to the Future where you're not going to see any hoverboards on there, you know, but it does help to depict that the world will change, but it's not necessarily, won't necessarily look all that different, although the underpinnings to it could be quite different from an energy perspective. So this gives us an opportunity to help depict, you know, one scenario, and the text on the slide may be a little small. You can find this graphic in the report I've referenced, but to also help connect people with, well, what does an energy transition mean for the commodities that we produce? So the smaller text on that slide will talk to you about, well, how much copper is used in a renewable energy system? How much steel or how much zinc is used in a wind turbine? And for us, this really starts to help people connect with how the TCFD and decarbonization applies to a company like Teck. The other comment I wanted to make on this slide, and I may have to repeat on the next one as well, is, you know, this is a scenario, and as someone producing one of these reports, and anybody who's tackled this will know, you know, it's really important to distinguish between a scenario and a projection. What I'm presenting here on the screen isn't our prediction of how the future will turn out. It's just one scenario, or one of many scenarios. And I think what's key for us is to understand the range of impacts those scenarios can have to inform our strategy. Next slide. So this is a summary of probably 30 pages of analysis and discussion in our report. And really, it highlights a few things. First, it just gives you a sense of the range of scenarios that we've analyzed. And one comment I want to make specifically here is the lower carbon scenario here is a 2-degree scenario. And one of the things we've heard quite a bit and that we contemplated when producing our last report was including a 1.5-degree scenario or lower. At the time, we didn't include that type of scenario, and it wasn't because we didn't want to. It was simply that we felt we couldn't find a robust enough data set to complete that analysis and really, you know, dig into the risks and opportunities. For our scenario analysis, we've relied for the most part on the IEA, but as Peter mentioned earlier, you know, there's a number of different reputable sources you can turn to, and I think this is actually one of the challenges that everybody will continue to face and to have to tackle as we produce these types of analyses going forward, which is there is a large set of information out there. And I think the mistake people can make is going down a path where they're trying to choose the right data set. And for us, I think we weren't married to, you know, the IEA is the absolute gospel of scenario data, but it is highly reputable and it does provide some quality analysis. And from there, we built off of it using supplemental sources where we needed to come up with our analyses. the other thing I'd point out is we've tried to summarize our risks by commodity and by transition and physical risks. And I think that paints a really important picture that may be obvious to some, but in the absence of having a visual like this isn't always intuitive, which is the transition and the physical risks for some commodities can actually be quite different depending on which scenario you choose. So while the transition risks may be lower, the opportunities may be lower or higher in the 3.5 degree scenario, you do end up facing quite a few or significantly more physical risks. Where it's quite the opposite when you get to the 2 degree scenario, where your physical risks are minimized relative to that other scenario, but you see quite a few different outcomes for your transition risks and your different commodities. So this is something I could probably spend much more than 10 minutes speaking to, but I thought I'd just share a few insights on how we've used those scenarios. And I think as Peter mentioned, and I know Bertrand had mentioned to me recently too, I think at the end of the day, the question is, well, how does this relate back to your strategy? And so if we go to the next slide, which is my final slide, and I think I'm doing all right for time. I think the TCFD process is one that has helped us to clearly articulate, as Peter said, what is our strategy? What processes are we taking? What is our governance for tackling climate change, risks and opportunities? But it is also fed internally to what our strategy is. So if we go back to those 4 pillars that I'd flagged earlier, and we look at our risks and opportunities and some of the analysis we've done aligned with our TCFD process, I think it's enabled us to start to drive our strategy and articulate that a lot more clearly. So if we go back to my original point about positioning ourselves for a low carbon economy, one of the things you'll hear in many of our investor calls and our call tomorrow is about how we started to rebalance our portfolio through our copper growth strategy, copper being one of the metals that has the greatest upside in the low carbon economy. And we reflect that in that image to the bottom left, which is showing our anticipated growth in copper from our QB2 project. Related to that is also the graphic in the middle at the bottom of the screen. And this is what I was referencing earlier about being a low carbon intensity producer. When we compare ourselves to many of the other large diversified resource companies, our carbon intensity tends to be amongst the lowest in the industry. Going back to the second pillar and reducing our carbon footprint, we set a goal earlier this year about targeting carbon neutrality by 2050. And I don't have time to go into the details today, but to the bottom right is a roadmap that we've been articulating or sharing externally to explain to people how we plan on tackling that goal and working our way towards neutrality. The third slide, the third pillar, I should say, we continue to support the use of carbon pricing policies, and towards that end, we've been a member of the Carbon Pricing Leadership Coalition for a number of years. And just going back to that scenario analysis and strategy piece, today a good majority of our business is already covered by carbon pricing policies. And if you think about strategy, it's not only important for us that we see governments support this transition, but it can also become a competitive advantage. So if you look at that graphic at the middle of the bottom of the screen, in a world where everybody faces an equal carbon price, tech is going to have the least exposure there. So we think it's important because we need to decarbonize as a society, but it can also provide a competitive advantage for us. And finally, I think the scenario analysis we completed really highlights the importance of ensuring that we are designing our operations and working with our supply chain partners to ensure that our supply chain is resilient, that our operations are resilient, so that we can continue to operate. And the more we see that climate change occurring, the more prepared we are, the greater the competitive advantage we may have in the marketplace. With that, I'll turn it back over to Rosalie.
Yeah, thank you, Chris. Very good presentation. We already have questions coming in, so we'll jump into the discussion with our third guest joining us, Bertrand Milot, who's the head of investment stewardship at Caisse de dépôt et placement du Québec, one of the largest public portfolio manager in Canada with over 340 billion of asset under management for more than 40 clients who are, for a large part, public pension fund. He's one of the architects of the CDPQ's climate strategy, I remind people to keep asking questions that we will answer in the Q&A or before, using the function Q&A that you see on the bottom of your screen. So maybe Bertrand, will turn over to you. Can we yeah, okay, you're there. We know that CDPQ is very active when it comes to climate change. Can you give us your views on disclosure following TCFD recommendations and how it helps your organization, how it helps investors?
Thank you, Rosalie, and good morning, everybody. Just a quick flashback. We in 2017 we announced quite a detailed climate change policy. We set ourselves to capturing opportunities. Climate change is not all about risks, but it is also about investment opportunities. We have set ourselves to reduce the carbon intensity of our portfolio by 2025 by 25%. And in 2019, we actually joined the Net Zero Asset Owner Alliance, which is a group of investors, mostly international, who are committed to reducing the carbon footprint of their portfolios to net zero by 2050. So that sets the framework. We do pay attention on what companies do with regards to climate change. It's very, very important to us. Maybe I should say a word also, which is pertinent to this discussion, about our investment style. We are a high conviction investor. We have a quite concentrated portfolio and do deep dive analysis in the companies that we want to invest in. We look at obviously their financial performance in the past. We look at their positioning compared to their competitors. We look at the quality of the management. We look at all sorts of factors, financial and extra financial. And in that context, it is key to us to understand how companies are positioning themselves with regards to climate change. Peter said, TCFD is about formalizing a storytelling, and most of us are parents. We know it's easy to tell a story if you have something to say. The problem is a lot of companies haven't even thought about it and therefore have nothing to say. And to an investor like us, it's very scary to hear that in 2020 a company has no plan. And Peter explained the TCFD, so I won't go over that, but you know, governance is an important part. Metrics also, especially for us, because we've set goals to reduce the footprint of our portfolio. But the key to us is the strategy part. And the strategy does not just involve sending an engineer up a chimney to measure emission. As Chris was explaining, it's how are your products positioned for the future? How are you going to deal with the physical aspects of climate change? And okay, it applies to tech, which is you know, in a sector that it's quite emissive. It applies to oil and gas companies, but it applies to every single company on the planet. At some point or another, consumers are going to want to buy greener products, and companies need to think how they're going to deliver them, whether it's food, whether it's your supermarket, whether it is children's toys or clothing. It applies to everybody, and we need to hear the story because as we progress and governments tighten regulation, impose more of a carbon pricing, we want to make sure as an investor that we are invested in companies that have a good positioning and have already thought about this. We don't want to be invested in companies that in a number of years when regulation is tighter, we'll say, OMG, oh, we're done, too late. So we look forward when we make investment decisions as to the sustainability, both financial and extra financial of companies, and need information. So it's key to us to hear about the TCFD and their plans. Just a few more words. To us, the strategy is key, even if it is at this stage only qualitative, because it's already difficult enough to think about it, let alone putting numbers on it. So qualitative strategy is a good thing and all companies should have thought about it? And if the answer is, well, we have very little risk because we're an IT company and we're basically operating in one office building somewhere and we use green energy, so be it, but we want to hear that. So that's the key. Metrics and climate scenarios is something that is incredibly difficult to do, and kudos to tech and Chris's work on that. It is something that we're paying attention, especially in companies that are highly emittive or in sectors that are highly intense in carbon. But to us, it is, at this stage in 2020, for most companies, it would be nice to have, but not, it shouldn't trump the efforts that are put on strategy. Thank you.
And Bertrand, just staying with you, what do you do when there's the company has no plan, has nothing to say?
Well, our strategy is not necessarily to divest. You know, our targets we expect, and especially with net zero, I mean, we're not going to be able to achieve net zero by ourselves. The industry and the point of the net zeros, our alliance, is to push the entire world economy to decarbonize so that our portfolio decarbonize themselves. Okay, it will require a lot of work. What we do is we try to engage with companies to put them in the right direction. And if in the end, the outcome of that process is unsatisfactory, maybe we'll decide that we'll stay invested in that sector, but actually change horse we're riding and go and find another company that has a better positioning in that industry from a climate change point of view. So we see that as, you know, a competitive advantage and the ability of the companies to deliver returns. We are long-term investors. We stay invested for even in listed markets, an average of 7 years. So we really look to the future. Okay,
good. Chris, Bertrand just said that his favorite recommendation is the strategy one. Do you have a top recommendation that you prefer?
I lean towards the strategy, but Peter made a very compelling argument. I've changed my mind during the call about the governance piece as well. And you know, I think as we're preparing these disclosures and we're doing the underlying analysis, you know, the TCFD in some ways is about being able to articulate the risks and opportunities for your organization externally, but they're just as much about internal engagement in many ways. And we've had incredible board engagement and senior management engagement, not just because of the TCFD, but because it's been an issue or a topic that many of our investors have wanted to think about. So the governance piece, the strategy, I mean, they're all important. It's really, at the end, it's hard to really pick one without immediately feeling like you've undermined the importance of all of the others.
Thank you. Peter, can you tell us what is the current state of adoption of TCFD across investors and company? Peter, you need to unmute yourself.
There we go. Boy, it's the entire landscape. I mean, there's so many that are sort of doing good work in their disclosure process. Others are just starting out. I mean, I guess there are a couple of just quick messages. It's where you are right now. I mean, you've just got to start somewhere. This is a longer journey. And I loved Bertrand's comment that he can't get to net zero by himself as an organization. So it's going to take this ecosystem. And one of the things that we discovered, because Ceres just did a series of case studies with asset owners who have developed their own climate action plans. 3 of them were Canadians. Ontario Teachers, OP Trust, and CDPQ. And in these case studies, one of the things that that continued to come out as a theme was this interconnectedness. So Chris is right. You can't really pick a particular recommendation category that's more important than the others, but they're all amazingly interrelated, and nothing's more interrelated than this whole strategy and metrics and targets one. And one of the things that came out in our conversations with these 9 asset owners is something that I think they're going to start including more in their future disclosure. You know, when they're using tools, when they're using data, when they're using models, it's not just sort of what they use, but going into it, what did they expect to learn? And then at the end of the process, what did you actually learn? And where do you go from here? So, you know, I think that's a message for everybody, whether you're a company or an investor at this point. It's take where you are and build upon it. And if you're a company, you know, tell this story to investors about why you're a good investment and why you're going to be a good investment 5, 10, 15 years from now.
I'm reading one of the questions asked by our participants. Would you, either companies or investors, find it helpful to have a standardized set of 2 or 3 scenarios to analyze company against? I mean, Chris, you've showed us many, and I'm sure Bertrand, you're reading a lot of different scenarios. So to the 3 of you, should we standardize scenarios?
I would say as a user of them, it would be helpful, especially per sector, because, you know, if we compare a mining company to another mining company, knowing that they operate on similar scenarios would be good. I don't think that will be possible it'll be already difficult enough to do it per sector. Let's not do it planetary. But also for oil and gas, it would be good to have standardized scenarios so that we can compare which are the better positioned. The risk obviously is then all these scenarios are not correct. Obviously they are scenarios. Nobody has a crystal ball that's good enough, but I think it would be incredibly helpful in any case. And I'd like to pick up also on what was mentioned, governance versus strategy earlier. To me, you can't have a strategic discussion without governance. Both are important, but strategy, again, is not just about sending an engineer up a chimney with something to measure CO2. It's about your supply chain, it's about product development, it's about training people, so HR is involved. It's about accounting for carbon, it's about et cetera, et cetera. So it involves everybody, which by essence means that every single department in the company needs to be involved. By essence, that means that there needs to be governance.
Chris? Oh, sorry. I was about to say, Chris, do you agree with that?
Yeah, I think I've got a mixed answer, which is in concept, if we said, you know, look at least these 3 scenarios and they were sort of the climate outcome scenarios, you know, what's a 1.5 degree scenario, everybody do 1.5 to whatever. I think that would be helpful. And I think where the challenge is going to lay and may not be overcome for good reason, which is the underlying information you use to depict and describe those scenarios is quite variable. So how a Bloomberg or an IEA or any data outlet you want to reference depicts a 1.5 degree scenario is going to vary. And so I think asking everyone to do analysis on a 1.5 degree scenario makes total sense so you can compare, but I think you'd have to stop short there because there are going to be strengths and limitations to any firsthand data set. And I think it would be challenging, if not probably inappropriate, for someone to come out and say, you know, data source X is the data source for each one of these scenarios, because they're often sort of macro scenarios. And if you think about a company like tech that's looking at multiple commodities, it's rare to find a single data platform that actually has data on all of those different commodities. So maybe that emerges over time. I would love it if there was a standardized data set that we felt was reputable. across each one of those commodities. But I think that's where the challenge will lay, is actually when you do the scenario analysis, what's the underlying information you're using? And I think for at least the foreseeable future, we're going to have to enable or allow that flexibility for companies to figure out, or at least be transparent on which data sets they're using to depict each scenario.
I want to stay with you. What's been the most or the easiest part and the most challenging part? What kind of questions does a company needs to tackle to determine whether or not you should produce a TCFD report?
Yeah, I think one of the easiest parts for us, and I tried to capture this a bit in my presentation, is it helped that we had been looking at climate change related risks and opportunities for a number of years. So the TCFD was great in providing a framework that would enable us to tell our story, and investors were asking us these questions all the time. So again, it gave us this really nice communication avenue to package everything up and share that externally. The challenges are many. A couple that I'll just flag to people quickly that I think you want to be aware of, and I've been monitoring some of the questions as we come up. And I think Bertrand and Peter have touched on this really well. You got to start somewhere, and some of this is about making the public disclosure. But at the end of the day, if your organization isn't prepared to actually think about the strategy and the governance pieces, the odds are the information you're putting out through a TCFD report isn't going to be all that persuasive or robust. So I'm not trying to discourage people from undertaking the practice, but I think you need to recognize that it's not just about disclosure, it's about thinking about your internal strategy. The one other challenge I think that's interesting about this, and it's very specific, but I like to flag it, which is this is a unique type of disclosure compared to a lot of our other sustainability or financial disclosures. And I think I saw a question here about time horizons. Mm-hmm. And when we think about securities requirements and some of our financial disclosures that have very specific guidance, and we tend to be much more shorter term focused on those disclosures, this is a little challenging to wrap our head around, putting out into the public domain how you think about projections 40, 50 years out that have a lot of uncertainty. And I think Peter touched on this. For now, I think it's a lot easier for companies to disclose on a qualitative sense, but to drill down to anything overly quantitative and that comes across as deterministic has some implications legally for how you disclose that. So how we reconcile the type of framework that a TCFD has with our other reporting requirements is one that I'd recommend people really take the time to think about and ensure that their legal counsel's review as well.
And we've got two questions that are related to smaller entities. So one questions relate to smaller pension plans who might not have expertise on staff. They might need to recruit assistants. So is there any recommendations for them? And similarly, what about investment in smaller companies, private investments? We're focusing a lot on big issuers, large cap, but what about the small organizations? Bertrand, do you want to start with that?
Yeah, I think we think at the CAS that TCFD should be as mandatory as tax filing for all sorts of companies, obviously not the corner bakery, but anything above a certain level of sales is exposed to climate risk, needs to grab investment opportunities. And so a lot of TCFD is done by public companies, are publicly listed. It should apply to all the private ecosystem as well, because we make investment decisions in this sector and we need the information. And with regards to smaller funds, I would say that there are consultants that can help you. I think it would also be good, and I know it may be difficult, but there is a lot to be learned with hands-on approach, and having one person, just one, actually focusing on this, better understanding the questions related to climate change, and being able to then potentially select consultants, interpret whatever the consultants is saying, given the way, the style of the organization, how they invest, etc., is key, so that you apply it. If you're small and you invest in index, you can't do deep dive on companies the way we do. So you need to look at it in a different way from what we do using different data sets potentially. So but somebody needs to understand that, one person, so that you can steer the organization.
One person internally.
Yes,
okay.
At least one.
Peter, you've got anything to add?
No, I think Bertrand said that very, very well. I just had a very short comment about that earlier question about sort of comparability of disclosure. You know, the data isn't comparable. So it starts to beg the question, which I think both Chris and Bertrand have raised, is that there's really more information to be had through some sort of qualitative discourse and disclosure than through a quantitative one. I think many people are struggling with trying to have a limited set of data sets and models that are appropriate to either all companies or even by sector yet. Maybe you have a comment on that, Bertrand.
Yeah, and I would say don't get lost in the numbers. The problem is you know, finance types tend to count basis points, tend to be focused on detailed numbers and making sure all the sums add up. In climate change, nothing adds up. The numbers are fuzzy, plus or minus 10, 15%. Nothing is linear. There is no historical data. That shouldn't scare you. Use common sense, use logic, use qualitative analysis as much as numbers. Because relying too much on numbers is risky. None of these numbers are right. And I say, to begin with, qualitative today, focus on qualitative, and then learn, and then go on to numbers, but don't get scared.
Well, this is going fast, so we're getting close to the end. Maybe a final question, final word from our panelists. I like the fact that you're giving recommendations, so I'd like each of you to maybe finish with a call to action or a recommendation for our audience. What can they do? Where can they learn? What should they rely on? Peter, let's start with you.
I'm going to borrow that wonderful phrase Bertrand just used. There's an awful lot of common sense in this. The TCFD truly is about storytelling. And if you think about it as an annual performance review, it's a performance review of the organization by itself. Where was it last year? Where is it today? And where's it going? I think that's incredibly important. And in the process, it gives investors confidence that you're going in the right direction.
Chris?
Yeah, I think what I leave people with is, you know, start taking action now and don't let perfection be the enemy of the good, right? This is a bit of a messy process early on. It's challenging, but start tackling these types of questions for your organization, this type of analysis. You may ultimately choose not to make a public disclosure line with the TCFD for another year or two, but you're going to take at least 6 months to a year to really think this through. But like I said, don't, you know, we had this experience early on where if you try to jump into some super complex model and quantify everything, your head will be spinning very quickly. So start taking that process, and I think Bertrand put it really well. Start with the qualitative, think it through, and then as the quantitative can add to that, you can build off it, go from there. But yeah, don't wait for this to be perfect. Just take a stab at it right now.
Bertrand, anything to add?
I would say to the investors that are listening, engage with companies in portfolio and push them to publish, push them to improve. The beauty of the TCFD is it's modular. It is quite well laid out. Start. There is no excuse in 2020 not to be on that journey, but nobody is asking for perfection, as Chris just said, and have scenario analysis. Have the governance in place. And then next year, do a bit more and continue. But start.
Incremental.
That's key.
Okay, well, as expected, this conversation was very interesting. I'm sorry for those who asked questions we didn't have time to answer. I tried to answer a lot of them, or ask a lot of them. Thank you all. Thanks to the participants, the panelists, to Ceres, to Tessa, who helped a great deal, Finance Montréal also for arranging today's webinar. We hope that it helped you improve, or it will help you improve disclosure around key elements of TCFD, learn valuable lessons on best practices, and discover useful resources and tips to improve your extra financial reporting. Florian is putting some links on the screen as we speak. So to find out more, you can look at those web links, Ceres TCFDs. Just this final word, Finance Montréal's next activity will be held in June, and it'll be a webinar on human capital management. So stay tuned for more details, and have a nice day.
Thank you.
Thank you.